Welcome. It is a day in the Pacific Northwest. We are heading towards 80 degrees, and I am excited for Mother's Day weekend. Judy, do you think you're going to be spoiled this weekend?
I better be.
Yeah, I've got my weekend planned, a lot of cooking.
Yeah, you
So, welcome to Getting Your Edge Out, a Right Size Your Home and Life podcast. I am Dennis Day, and my co host is.
Judy Grattan.
Our special guest today is Gary Kawano of Success Lending, and he's here to talk about blending interest rates, how this can help downsizers. Gary, please introduce yourself and tell us who you are and about your company and your lending.
Okay. Um, like Dennis said, my name is Gary Kawano, and I'm currently in Carlsbad, California. Husband, father of four, and been in the mortgage industry for about 30 years. Um, I work for Success Lending, and we are a combination, a joint venture, if you will, of Kind Lending, company owned by Glenn Stearns, and EXP Realty. They've come together and formed Success Lending. So Success Lending's been around for a couple of years, but the staff and the team are definitely veterans in the industry.
Would you like to
Yeah,
go with the first question there, Judy?
Sure. Well, to begin with, Gary, can you please explain to people what a blended interest rate, what is that, and how does it differ from talking about just a regular mortgage rate?
yeah. An interest rate can be interest rate on anything: credit card, car, home, and that's the amount of finance charge you're paying on that amount borrowed. So it's, interest rate is the amount of interest you're paying as a finance charge for the year. A blended interest rate isn't that isn't something that's commonly used, and we're hearing more and more about it because a lot of folks were smart enough and lucky enough to secure a really low interest rate on their large purchase transactions like their mortgage, their automobiles, things like that when rates were really low. Now, now the rates are higher. People are reluctant to they're really proud of that great mortgage rate they got, and rightfully so. You know, a lot of times it's the largest thing they're financing, so they're really they love that rate. But in reality, a lot of Americans are also getting other debt: automobiles, credit cards, student loans, personal loans, etc., home improvement loans, and those rates are going to be a lot higher. So hence the term that's becoming a little bit more popular is what is your blended rate? You know, a lot of people can quote off the top of their head what their mortgage rate is, right? They see it every month, or they remember when they secured their mortgage, but they may not know their blended rate, which is what is your interest rate with all your finance charges combined in a form of an interest rate. Once
So
we get that rate, then it kind of easier to compare.
how do you calculate that rate? I mean, is it an average of all your interest rates, or just exactly how do you get there?
Yeah, and I can actually send you a link that you could forward to any of your listeners that want. I just created an Excel spreadsheet. I do it on my calculator, but it is exactly that. It's an average of your finance charges in proportionate. So you have your interest rate and you have your balance, and that's going to determine your finance charge. If you have a number of different, debts, we can determine what the finance charge is for each debt, and then that would allow us to determine what the blended interest rate is.
And I know it's interesting because we were having a meeting at a Starbucks the other day, and a gentleman asked us if we were in real estate and started talking about they were renting and waiting for interest rates to come down and home prices to come down. And I tried to explain the blended interest rate to him because that makes so much sense to me. I think currently in the economy that we're in right now, a lot of people have begun to rely on credit cards to make up because things like food and gas and the things that we cannot not buy um, are the prices have gone up. and especially people who are considering downsizing, some of which are on limited fixed incomes, those credit cards become very easy to use. And so, with this blended rate, how would it benefit them to go ahead and sell? Because a lot of people don't want to move because of that 3.5% interest rate. I was one of them. And once I heard the term blended rate, I'm like, whoa, what is that? And so, how
Yeah,
would it?
so exactly. So I use the a blended rate as a tool to help compare or help us decide our options. So it's a gauge, it's a metric, it's a barometer of what they're paying in finance charge. So we wouldn't go out and secure a blended rate, but it allows us to use it, just like blood pressure or weight or BMI, something to kind of gauge the health, the financial health of that person. So, for example, I just used a past client, and I punched it in for preparing for this call. Um, this person had a mortgage of 4.5%, balance 200,000, an auto loan 8.62. I made that up. I just looked up the national average, 20,000. Credit card, again, I just Googled the national averages. 19.2, one at 19.2 for 10,000, one at 19.2 for 15, one at 14.51 at 15, and one 14.51 at 9,000. Again, I just searched on Google. And so the total of liabilities was 269,000. Their mortgage rate was 4.5. Great interest rate. A lot of folks got even lower rates, some higher depending on when you got it, what type of loan, a lot of things. But so the rate in their mind, the rate that they're familiar with, the rate that they could quote off the top of their head is 4.5, but their blended rate is actually over 7%. Even though the debts that are smaller, add up, but those are the ones at the higher the rate that bring that average from 4.5 closer to 7. Um, so that's kind of I use that tool as a blended rate, or use a blended rate as a tool to kind of see what their overall finance charge is on their liabilities.
And how does that blended rate impact their monthly payments? So they're looking at the mortgage, and the payment is so much better than what they could hope for, but they're also paying those credit cards, hopefully, and the car and everything else. So
Yeah, two things. Again, just like we're looking when we do a full spectrum analysis, the interest rate is going to let us know what their finance charges are going to be. Cash flow is going to be different. So cash flow is going to be their monthly payments. So with that same borrower, I kind of did some rough numbers with a financial calculator and estimated what their payment would be on those rates with those terms. And the total rates, so the mortgage payment was 1432, but the total payments with the automobile and the 4 credit cards was 2,806, 2,806. So two different things that we're looking at. One is what's the cost of the finance, and the other is what's the cash flow hurt, what's the monthly cash flow. With that, I kind of, again, to look at the real estate example, I said, what if that person, secured a home a long time ago, but let's say the home's worth 800,000 today, and a home in your area is 750. I just kind of Googled a couple of the cities in your area. Is that how off am I on that? That's on
not
the lower end,
too
probably.
bad. I mean, that's probably on the lower end in
Yeah,
parts,
yeah,
but just I think
yeah,
overall in Washington State, that
yeah.
would
I didn't want to scare them with the house on the hill, so I just kind of used 750 to get the conversation started. So it's sold for 800 in this example. Look and buy for 750. The first thing is can't do it. Judy, the interest rates are twice what mine is. My payment's twice as high. There's no way. Maybe if rates drop to 4.5, I'm barely able to make ends meet as it is, kind of thing. So I didn't take in consideration taxes and insurance because that's such a variable. I mean, if
Mhm.
you're coming from Chicago or California or Texas, you know, East Coast, all the taxes are different. So that's kind of more of a one-on-one conversation that they'd have with you. But just in general, let's just look at payments. I can look at interest rate and I can look at payment because that's going to stay the same for everyone. So that person that sold for 800,000, if you take I just looked up average commissions and cost for selling a home minus that $200,000 mortgage that I used in my example, they would have and then paying off all the debt, paying off the car, paying off four credit cards, they would have 475,000 to put down. So putting that 475,000 down on that $750,000 purchase, I use today's rates, 25% down. I use 6.75. This is as of May 10th. Um, uh, uh, or if I did a 15-year at 50% down at 6.375. Again, no points. Um, Not to get too technical lingo, just kind of let the listeners know what kind of rates I'm using. Um, it's actually surprising. Their new rate is, let's see if I can read my notes here. Well, obviously 6.7 because the blended rate is just one rate because there's no other debts. So their interest rate is actually lower than the blended rate that they had before.
Right.
And on a cash flow, even though their home loan goes up because their mortgage goes from 200 to 275, so their loan does go up. So the home loan payment does go up by $441, but their interest charges goes down $6,078 a year. They're saving on interest, and their payment, their cash flow, actually improves by $933. So
Wow.
again, just kind of food for thought. It's not my payment's going to be twice as high because a lot of times people are thinking, well, do I have a car payment? Do I have some personal loans? Do I have a home improvement loan? And those are the kind of things that I like to have that conversation that sometimes people are missing. Just another option.
And when you were talking about, this hypothetical client that you had with, um, what their total cash flow was, my question, the thought was, with four credit cards, how much are they paying off on those credit cards? So how much more, are they paying out in interest? Because if they're only making minimum payments, the interest really starts to begin to build up, that they're going to end up paying. And it just, I mean, it makes when I heard that term, blended interest rate, a light bulb went off in my head because I personally am one of those people who would very much like to downsize, and I'm hanging on to that 3.5% interest rate.
Yeah,
I don't have car payments right now, but I do have some credit cards and a HELOC, and I have to look at that. I'm going to have to look at that, and once I know what that number is, it will make it much easier for me, I think, to at least look at the option of buying at today's rates, because what is so hard for people to understand is these homes are going to continue to appreciate. So if you can buy now, even if it's at a rate you're not particularly fond of, rates go up and down, and you could refinance the loan in the future at a lower rate, but you've saved so much money by purchasing now rather than waiting 2 years when the home has maybe gone up $200,000. So
absolutely,
it,
absolutely.
it seems like a
Secure a
win.
little lower tax rate, and we there's a saying: you marry the home and you date the rate.
That's
You know,
it.
the
Yeah.
rates come and go. No one knows. We try to we spend a lot of money to predict what rates are doing. No one knows, but yeah, we do know this. They go up and down.
Hmm.
Gary, how often should homeowners be assessing their blended rate versus their mortgage rate to see what they are really paying for debt?
I'd say on average, once a year would be fine.
Hmm.
Just kind of assess if you've um, uh, got any new liabilities? Have you bought a new car, got a new line of credit, transferred any credit card debt, or added a new credit card, things of that nature. The mortgage, you're typically not refinancing that too often, but it's not uncommon to, buy another car for the kid, or they've got their driver's license, or, um, you know, uh, uh, opened up a new line of credit just to um, homes are so expensive. You looked at homes and everything's so expensive. You decided to get a home improvement loan, and do the home improvements on the home you have, that kind of stuff. So once a year, I would say.
Oh, in essence, you're combining all your debt and getting an average interest rate on all the debt versus just your mortgage. Am I correct?
Yeah.
Yeah, yeah. And again, it's a financial tool that we're using to analyze financial health. So and kind of a truer cost of your debt.
Hmm.
It's a little harder it's easy to know what you're paying on your mortgage. It's a lot harder to know what you're paying on all your debt combined. This can also be used as a tool for refinancing. So a lot of times mortgage brokers or mortgage lenders will use this tool to see if it's a benefit to refinance. If your mortgage is 4.5%, when does it make sense to refinance that debt? Maybe do a cash out mortgage and combine all your debt. That's another use for the blended rate. Um, uh, is figuring out what your total cost is. So then, if you got a new mortgage to pay that off, what would that interest rate need to be in order for that to make sense? That's another commonly used thing for the blended rate.
So, Gary, could someone come to you for that information? And what would they say to you or another lender if they wanted to know, if they wanted to see that number and understand how it's affecting their daily lives and their cash flow and the whole nine yards to make a decision? I'm kind of beginning to see that um, we try to encourage people to pay attention to the value of their home because every time a home it sells, it changes the
Mm.
value of your home, but at least annually to look at that, to look at what your equity report is to determine how much money you have in your home. And I'm beginning to think maybe this blended rate should be done on an annual. It's almost like some kind of, I'm trying to come up with a term for the whole shebang that people should look at because this is often the largest investment that people have is their home, and there's so many parts that affect their lifestyle and whatnot. But so could they come to you and say, what would they say?
Yeah, if I knew their balances and the rate on each liability associated with that balance, I could quickly determine their blended rate, which would be kind of the true cost of their outstanding liabilities.
And
And I'd
then
be more happy to do that.
can you give them any advice regarding that if they're not sure what they want to do, if they don't know if they want to refinance, sell, whatever, stay within that? Is there, you know, could you help them make an educated decision, I guess?
Yeah, I mean, every situation's different, and the
Right.
two things that I like to kind of focus on, one is the cost. So if money is no object, what's the smartest use of your money? What's the lowest cost of your money? That's one way to look at it. The other is cash flow. In some cases, we just can't afford the quote unquote smartest thing to do. Sometimes we have to get a credit card, or sometimes we have to get a line of credit, or sometimes we're doing a 30-year term versus a 15-year just for cash flow. So, and then real life is you try to balance them both, right? It's kind of like eating healthy in real world situations. We try to do the best with what we have, and that's kind of in finance. But yeah, just like it's a good idea to jump on the scale every once in a while. It's a good idea to get a financial checkup, if you will, see what your home value is, just so you know your options. When the stock market's going crazy, I rush to open up the stock statement, but sometimes it's better just to throw it in the desk, and you don't have to open it up every month. Same thing with this. I mean, everyone knows, try to reduce your liabilities. The banks are making money for a reason by lending it out, so try to pay it off as soon as you can, and try not to finance as much as you can. Those are kind of good rules of thumb, but life is life and reality is reality. And it may be someone wants to relocate to a single level home or closer to their children. That's not necessarily a strictly financial decision. It's more of a, can I do it? Is this
Right.
something I can do? I want to live closer to my family, or I want to live in a different climate, or a safer home for me as I'm getting older. And that's a whole different conversation.
Right. But I mean, all of this is part of it.
Yeah,
What's the value of your current home? What's the condition of your current home? What are the needs there? If you were going to sell, or if you were going to stay, what is your financial um, obligation, the blended rate thing look like for you? And
correct.
I think it's so important for anyone, I don't care if they're downsizing or not, to have a pretty good idea of that. And when I heard that, I was just, I never heard the blended rate thing before, and I was fascinated by that.
Yeah, it's more of an industry term, so it's not really out there. I don't. And when you asked me about it, I was absolutely happy to to talk about it. But it's definitely something that most um, industry professionals aren't using on the real estate side. It's something a little bit more. Yeah,
I haven't heard the term, but I think it is. I think more people should be looking at it, talking about it, because I know personally I'm hanging on to that 3.5% interest. um, I don't think I'll ever see it again in my lifetime. And it's like the conversation we had with this person. It's like I'm waiting for the home prices to drop, and I'm like, well, the thing about dropping home prices is it generally means we have a very bad economy. And I said, so it's not really a win when prices go down. The thing to try and do is get in now, buy something, and then work your way up to your dream home. Uh, but you're always paying, if you're paying rent, you're paying somebody else's mortgage. So you might as well pay your own.
yep.
So anyway, well, that I personally think is really fascinating. What do you think, Dennis?
Yeah, it's just a more comprehensive look at your whole financial situation versus kind of a siloed look at just your mortgage rate. Wow, I've got this great mortgage rate. Well, yeah, but what is the whole financial picture? And Gary, you've probably run into people who are like, oh, well, maybe we'll sell our house, but those interest rates, etc. Have you come across situations where people have maybe decided that, oh, this is a good idea, that selling the home and getting rid of debt and so forth is actually a benefit?
Absolutely, absolutely. You know, like I said, a lot of folks, uh, we're all in the same boat. It's not unusual that uh, they'll have a very low interest rate on their mortgage. With that, right along with a higher rate on an automobile, home improvement loans, credit cards. That's more normal than unusual. So I see that a lot of times. So a lot of times the conversation um, is we're moving, we're selling one home, we're buying another. Should I pay off this debt or put a larger down payment towards the home? Those are usually the conversations we're having. That's when I'll break out this tool. And more often than not, it makes more sense to pay off that that debt and put less down on the mortgage, because yes, you're getting a larger mortgage, but you're getting a larger loan with the rate in the sixes versus the rate in the teens.
Right.
So and then also it helps with that cash flow, because a lot of times when you are resetting, in this example that I gave, there were the their cash flow is improving by $933. But again, I wasn't taking any taxes or insurance in consideration. There's it's common that your taxes are going to go up. So that $933 savings in the payments can help offset a possible increase in your property taxes.
And insurance going up.
Insurance is going up, same thing. That's a whole other podcast. The insurance thing's crazy, and we're seeing that across the country.
Yeah. Okay.
So Gary, now you're in California.
Yes.
Are you licensed? I mean, can you do loans outside of California, or would you connect them with someone else within your organization if they reach out?
Yeah, I can refer them to across the country, all 50 states. I'm licensed, in 10 states, so I could personally help them in a number of states as well. But yeah, but more than anything, I'd love to be a resource. Like I said, I'll send you that link. I could send them that link, so it's nothing fancy, but it's just something I created for this call. So
We'll link it to the podcast so they
okay.
can access it.
Yeah, and but more than happy to answer any questions or be a resource for them.
Okay. So we'll put your contact info in the transcript and the summary of the podcast. Is there something else you want to share with us?
No, I just appreciate the opportunity. Like I said, I'm sure you're not alone on the interest of this, because it's not a commonly thought of concept, to be honest with you. So kudos to bring that up. I think your listeners would hopefully found some insight on that.
Gary,
All
thank
right.
you so
Wow.
very much for your time.
I'm so excited. I've learned something, and I'm going to start looking at my whole debt rather than just my great mortgage rate. And we should somehow, we got to get the word out to particularly the downsizers who really do. I think there's a great desire for people to change, but they just can't because of those low interest rates. So,
Absolutely. Well, thank you, Judy. Thank you, Dennis. I appreciate it.
God, awesome. Really, thank you, Gary. And we'll put all your info in everything we do. And as soon as it's up and running, we'll give a link to you. Okay.
Awesome. Thanks, guys.
Thanks.